Hey everyone, it is me again. It has been a wild ride in the markets lately, and honestly, it always is not it. Sometimes I just sit back and shake my head, thinking about how many times I have been burned, trying to outsmart the system or just trying to get rich quick. I remember being in my early 20s, fresh out of college, with a decent chunk of savings from working part-time. I felt invincible. I was watching all these people on the internet talking about how they made fortunes overnight, buying this stock or that crypto, and I thought, hey, I am smart. I can do that too. What could go wrong, right? Oh, if only I could go back and whisper a few words of wisdom to that younger, more naive version of myself. I probably would not have listened anyway. But still, I would have tried. I got caught up in the hype, just like so many others. The promise of high returns, the stories of people doubling their money in a week, it was intoxicating. I mean, who does not want to get ahead, especially when you are just starting out and your bank account is not exactly overflowing? My family, they were just regular folks. They worked hard for every penny. And they never really talked about investing beyond saving for retirement in a very traditional way. So I did not have a lot of guidance, and I certainly did not have anyone telling me to slow down or think twice. I dove in headfirst, chasing after every hot tip, every trending stock, every whisper of a next big thing. It was not investing. It was gambling, pure and simple, but I just did not see it that way at the time. I convinced myself I was being smart, being aggressive, being a savvy young investor. Looking back, I was just being foolish. I remember one time I heard about this stock, everyone was talking about it, saying it was going to the moon. I threw a significant portion of my savings into it without doing any real research, without understanding the company, without any risk management plan. It felt like a roller coaster, thrilling at first, seeing my portfolio tick up a bit, but then it came crashing down. And I mean crashing down hard. I held on, of course, because everyone said, buy the dip. It will recover. You only lose if you sell. So I held, and I watched my money evaporate. It was a painful lesson, one of many. I learned that just because everyone is talking about something does not mean it is a good investment. In fact, it often means the opposite, that the smart money is already out, and you are just left holding the bag. Then there were the scams. Oh, scams. I was so desperate to make up for my losses, so eager to find that magic bullet, that I started falling for things that now, looking back, seem so obvious. There was this one project, it promised ridiculously high daily returns, something like 1% a day, guaranteed. I mean, 1% a day, that should have been a huge red flag, waving wildly in my face, but my judgment was clouded by greed and desperation. They had a fancy website, testimonials, a whole community built around it. It all felt so legitimate. I put in some money, and for a few days I actually saw those returns ticking up. I even convinced myself I was brilliant, that I had found the secret. Then, one day, poof. The website was gone, the Telegram group was gone, and my money, well, that was gone too. It was a gut punch, a terrible feeling of betrayal and stupidity. It made me question everything. I also got into short-term trading, thinking I could just hop in and out, make a quick buck on price fluctuations. I would spend hours staring at charts, trying to predict the next move, reading every news article, looking for any edge. I bought high, sold low, bought low, sold even lower. It was a cycle of frustration and regret. The transaction fees alone ate into my capital, and the emotional toll was immense. Every small loss felt like a personal failure, and every small gain, which was rare, made me feel like a genius, only to be humbled again soon after. I realized then that I did not have the temperament for short-term trading, and frankly, most people do not. It is a game for professionals with sophisticated tools and strategies, not for an amateur like me trying to figure it out from my laptop. One of my biggest mistakes was not understanding risk management. I would go all in on a single idea, convinced it was a sure thing. I never diversified, never set stop losses, never considered how much I could afford to lose. I just focused on how much I could gain. It is like driving a car without brakes. Eventually you are going to crash, and I crashed hard. Multiple times. I learned that you have to protect your capital first and foremost before you even think about making money. You need to think about not losing it. It sounds simple, but it is a lesson I had to learn through immense pain. It is easy to get caught up in the excitement, to feel like you are missing out if you are not taking huge risks. But that is a dangerous mindset. The whole experience of losing my hard-earned savings, it was a wake-up call, a very, very expensive wake-up call. After that, I completely changed my approach. I stopped chasing quick riches and started focusing on solid, fundamental principles. I read books, watched legitimate financial education videos, and spent countless hours understanding how the market actually works. Not how I wished it worked. I learned about compound interest, diversification, asset allocation, and the importance of long-term thinking. I started with a clean slate, emotionally and financially, and built a new strategy based on prudence and patience. It was not exciting, it was not glamorous, but it was effective. I am not a financial guru. I am just a guy who made a lot of mistakes, so you do not have to. My goal here is to share my screw-ups, my missteps, and my hard-won lessons so that maybe, just maybe, you can avoid some of the pitfalls I fell into. It is about building a solid foundation for your financial future, not about hitting the lottery. Let us talk about what is happening now and some of the things that still make me nervous based on what I have seen and learned. There is a lot of talk about bubbles and crashes, and some very smart people are ringing alarm bells. Michael Burr, the guy from The Big Short, he is one of them. And when he talks, I tend to listen because he has been right about big market movements before. He recently sent out a warning to investors, and if you have studied market history, you know that when someone like him sends out a warning, it is probably worth paying attention. He has some pretty strong opinions on Bitcoin, on big tech stocks like Alphabet and Tesla, and on the overall market, he thinks the whole thing could come down, making it really hard to protect yourself if you are heavily invested in long stocks in the United States. He also thinks there are some safe havens, but we will get to that later. First, let us dive into his thoughts on Bitcoin. He tweeted BTC patterns. This is about the price history of Bitcoin. He sees a pattern that looks very similar to what happened back in late 2021. You know, the big run up, the peak, then a drop to a support level, another peak, and then a decent collapse downwards. He sees something very similar happening recently with two peaks and then a downturn. Now, you might think he is suggesting that Bitcoin will just keep dropping, hit a support level, and then have another huge price increase, just like in the past, but he actually does not think that at all. He said, I think Bitcoin at 100,000 is the most ridiculous thing that same people are sitting on television talking about Bitcoin. They read just casually. It is 100,000, it is down. Now it is 98,000. It is not worth anything. Everybody's accepted it. It is the tulip bulb of our time. It is worse than a tulip bulb because this has enabled so much criminal activity to go deep under. And honestly, when he talks about criminal activity, he has a point, no matter what the super enthusiastic crypto believers say. Bitcoin does attract criminals. Think about it. When Colonial Pipeline paid its hackers $4.4 million in 2021, they paid in Bitcoin. When JBS, the world's largest meat processor, got hit that same year, they paid $11 million in Bitcoin. This is one of the reasons why Burr thinks Bitcoin will end up like the tulip mania, all hype, all speculation, but not a very good underlying asset. And if you know Michael Burr, you know he is not afraid to take strong positions when he sees an opportunity. Now, a lot of you out there might be interested in exploring markets, maybe even trying your hand at futures trading, but without risking your life savings. That is why I wanted to mention something like Plus 500. It is a platform where you can explore markets. One of the really cool things is that you do not have to start with real money right away. They have a demo account. You can use Plus 500's demo to study the game, understand the risks and rewards, and figure out what strategies work for you, all without losing your actual hard-earned cash. It is a great way to learn without the pain I went through. Plus 500 is an online trading platform. It is listed on the London Stock Exchange, and it is regulated by the CFTC and NFA in the US, which adds a layer of oversight and credibility. It also partners with major organizations globally and has millions of registered users. Basically, Plus 500 gives regular traders access to futures across different asset classes like indices, forex, energy, metals, agriculture, and these types of instruments. So, what exactly is futures trading? Futures are an agreement to buy or sell something, a stock, an index, a currency, oil, wheat, at a set price on a set date in the future. Traders use it to speculate on where these prices are going without ever needing to own the actual asset. Okay, so when you log on to Plus 500, you can switch straight into demo mode. This way, we can walk through the platform, place trades, and get a proper feel for how everything works without any real money on the line. The platform includes a wide range of instruments, gold, the SP 500, cocoa, and more. What I like most is the simplicity of the interface. Instead of overwhelming you with clutter, it keeps things structured and easy to navigate. If you want to search for a specific instrument, say copper, just type that in the search bar, and it comes up straight away. It gives you a nice, clean interface with the latest info, live statistics, and options to sell or buy. You can add or remove it from your watch list or click on trade to see the different order types and the risk management tools you have at your disposal. Now, obviously, if you know anything about futures trading, you know it carries risk. But Plus 500 does give us advanced risk management tools like stop loss and take profit orders, so you can protect your capital from extreme downturns. For anyone interested in exploring futures trading, Plus 500 is a good place to start. Use the demo mode to test your strategies and get familiar with the platform's full set of built-in tools before trading live. You can also get a $30 bonus when you deposit at least $300 using the code Cooper30. You can find the links in my bio. Now, back to Michael Burr's warnings. He also has some thoughts on Alphabet or Google stock. With Alphabet, I think there is a pretty obvious use case who has not found Google useful at some point. So, what is Burr saying will happen to this stock? Burr made a tweet warning Alphabet stockholders. This tweet was all about Alphabet's plans to issue a 100-year bond, which would be the first tech 100-year bond since the dot-com era. Burr said, Alphabet looking to issue a 100-year bond. Last time this happened was Motorola in 1997, which was the last year Motorola was considered a big deal. At the start of 1997, Motorola was atop the 25th of market cap and top 25 revenue corporation in America. Never again. The Motorola corporate brand in 1997 was ranked #1 in the US ahead of Microsoft. In 1998, Nokia overtook Motorola in cell phones, and after the iPhone, it fell out of the consumer eye. Today, Motorola is the 232nd largest market cap, with only $11 billion in sales. If you look at Motorola stock, it issued its 100-year bond in 1997. We then saw peak mania and a price topping in March 2000. After that, we saw the stock drop over 90%, and it took 21 years to recover to that price. Burr is essentially saying that the same thing can happen to Google. It can go from number one, or at least around that, to a mid-tier, largely irrelevant company worth a fraction of its current value he mentioned. Google is the value investor's favorite in that group. It is the one that everybody said, well, it is cheaper than all the others. It is a relative value, and it is Google. But I know that since I got ChatGPT and Claude, I don't use Google, right? And Google search. The magic thing about Google search was how little it cost. Yeah, because most requests were not monetizable. So for the 85% of searches they get that are not, nobody's going to buy, even looking to buy anything, or think it is not product related, it is history. What did Columbus really do? It is not monetizable, and so they better not lose a lot of money on that. AI changes that AI is expensive. I run queries regularly that I know cost tens of dollars just for my inquiry. One inquiry, Google had those searches down to infinitesimal fractions of a cent. So that business is the golden goose, and it is really basically all their cash flow. Burr's main point is that when you have a golden goose for so long, sometimes you can get arrogant, you think you are the king, you lose innovation, and you think your business model is eternal. So you issue a 100-year bond. The Motorola parallel is a really stark comparison. Motorola was the undisputed king of communications in 1997. Within 1 year, Nokia humbled them. Within a decade, Apple destroyed them entirely. The 100-year bond was issued near the exact top. It makes you think, does not it? But it is not just Google that Burr has a warning for. He is also concerned about the overall market, especially with the rise of passive investing. He said, today, it is all passive money, and it is a lot. It is over 50% passive money. There is index funds. Less than 10% of money, some say, is actively managed by managers who actually thinking about the stocks in any kind of way that is long term. And so the problem is in the United States, I think when the market goes down, it is not like in 2000 where there was this other bunch of stocks that were being ignored and they LL come up even if the NASDAQ crashes. Now, I think the whole thing is just going to come down, and it will be very hard to be in a long stocks in the United States and protect yourself. And so that is why I decided to get out of it. Let me explain what he is actually saying here, because this is something I have learned the hard way about too. When you buy an index fund like an SP 500 ETF or a total market fund, you are not picking individual stocks. The fund just automatically buys a little bit of every company in the index proportional to their size. Apple is big, so you get a lot of Apple. A random mid-cap company is small, so you get a tiny sliver. Nobody is actively asking, is this stock actually worth buying? The money just flows in and everything goes up together. Now, that is fine, great, even when markets are going up. But Burr's point is about what happens when people start to sell. When panic hits and everyone starts pulling money out of index funds, the fund has to sell, not just the bad stocks, not just the overvalued ones, but all of them indiscriminately, because that is how it works in reverse too. In 2000, when the dot-com bubble burst, the NASDAQ crashed, but value stocks, boring companies, stuff that had been ignored during the mania, they held up or even went up.